Have you ever heard the phrase, "Don't put all your eggs in one basket"? Well, in the world of investing, ignoring that advice can cost you big time. Did you know that nearly 60% of young investors in the US keep their entire portfolio in just one or two types of assets, leaving them dangerously exposed to market swings? Are you making the same mistake? If so, you're risking your future wealth. Stick around, because in this video, I'll show you exactly how to diversify your portfolio like a pro and minimize your risk even if you're just starting out. Welcome to Smart Money Moves. If you're here, it's because you want to make smarter financial decisions and build long-term wealth. Diversification is the cornerstone of successful investing, but for too many young adults, it's an afterthought. Here's the deal. A properly diversified portfolio doesn't just protect you from big losses, it's also your key to steady growth and financial stability. Today, I'm breaking down simple yet effective ways to diversify across assets and industries so you can minimize risk and sleep easy knowing your money is working for you. By the end of this video, you'll have the confidence to take control of your portfolio, no matter your starting point. Tip 1. Spread your investments across asset classes. The first step to diversification is to invest across different types of assets: stocks, bonds, real estate, and even alternative investments like REITs or commodities. Why? Because these assets typically perform differently under the same market conditions. For example, when stocks take a dip during a market downturn, bonds often hold steady or even gain value. This balance can prevent your portfolio from taking a nosedive. If you're just starting out, consider a 60-40 split between stocks and bonds and gradually adjust based on your risk tolerance and financial goals. Practical action. Use low-cost ETFs, exchange-traded funds, to gain exposure to multiple asset classes with a single investment. Vanguard and Fidelity offer excellent options that are beginner-friendly. Tip 2. Diversify within asset classes. Don't just buy one stock or stick to US companies. Within each asset class, spread your money across sectors and regions. For stocks, this means investing in different industries like technology, healthcare, consumer goods, and energy. Globally, look at opportunities in international markets like Europe or emerging economies. Real-life example, during the 2020 pandemic, tech stocks skyrocketed, while travel and hospitality tanked. If your portfolio was concentrated in just one sector, you'd have either hit the jackpot or taken a massive hit. By diversifying, you can smooth out these ups and downs. Practical action. Look into total market ETFs, like Vanguard's Total Stock Market ETF, VTI, or sector-specific ETFs to get instant diversification. Tip 3. Don't forget about real estate. Real estate is an excellent way to add stability and growth potential to your portfolio. You don't need to buy a property outright to benefit. Options like REITs, real estate investment trusts, allow you to invest in real estate with as little as $100. Tangible benefit. Real estate typically has a low correlation with the stock market, meaning it can act as a buffer during economic downturns. Plus, it often provides passive income through dividends. Practical action. Research REITs that focus on commercial properties, residential developments, or even niche areas like data centers. Platforms like Fundrise make it easy to start small. Tip 4. Mix in alternative investments. For those ready to go beyond the basics, consider alternative investments like cryptocurrencies, commodities, gold, silver, or even collectibles like art. These can add a layer of diversification that isn't tied to traditional market performance. But a word of caution, alternative investments often carry higher risk. Limit these to a small percentage of your portfolio, say 5 to 10%. Practical action. Platforms like Coinbase or Binance make crypto investing accessible, but always do your research and avoid get-rich-quick schemes. Tip 5. Rebalance regularly. Your portfolio's balance can drift over time, as some investments grow faster than others. Rebalancing, or adjusting your portfolio back to your original allocation, helps you maintain the right level of risk. For instance, if your stocks outperform and grow to make up 80% of your portfolio, it might be time to sell some and buy more bonds or other assets. Practical action. Set a reminder to rebalance your portfolio every 6 months, or use an automated robo-advisor like Betterment or Wealthfront to handle this for you. Tip 6. Keep an emergency fund separate. Before diving too deep into investing, ensure you have an emergency fund. This cash cushion, 3 to 6 months worth of living expenses, will prevent you from pulling out investments during a market downturn or personal crisis. Think of it as your financial safety net. Practical action, high-yield savings accounts from banks like Ali or Marcus are perfect for keeping your emergency fund accessible and earning some interest. To recap, diversification is your secret weapon for minimizing risk and growing wealth. Spread your investments across asset classes, industries, and regions. Add real estate and alternative assets for extra stability. And don't forget to rebalance regularly and keep an emergency fund handy. Now is the time to take action. Start small if you need to, but start today. The earlier you diversify, the more you'll protect your future and set yourself on the path to financial freedom. If you found this video helpful, hit that like button and share it with your friends. And don't forget to subscribe for more expert tips on building wealth and living your best financial life. See you next time.